Hello, everyone. Welcome to the weekly Investor Roundtable. We're here to talk about Street Yuma LLC. You've got Nick Young and
Lane Cougar.
awesome. Well, again, thank you for joining us. For those who haven't joined us before on our weekly roundtables, we want to make this interactive. So if you have questions, ask now. If you want to go ahead and ask now, we'll get it started. But as we go through the presentation and the roundtable, please ask questions. We'll make this interactive and keep you updated as we move forward. A little bit about F Street again, who we are. We're an alternative real estate investment company. We aim for returns, above the market, invested specifically in real estate assets. Going over specifically a recent opportunity, if Lane wants to go through it.
Yeah, so just a week ago today, we released F Street Normal LLC to our investor base. And as of Tuesday this week, we can say that we are fully raised for the deal. So it was awesome. It was a $4.3 million equity raise. It's a fantastic deal. We have a credit tenant in the building with over 10 years on a lease. We're very excited about it. We're going to closing soon. And thank you all for helping us get this done.
Yeah, and really, I know we've been busy. I mean, a lot of opportunities coming forward here in late August, early September that really just coming together all at the same time. Our industrial portfolio, we have over 250 million in assets. We're now over 3.5 million, coming up on 4 million total square feet of industrial assets throughout the United States. And as we've talked about with our buy box, we're looking for those good value deals, creating value for our investors, creating where we can maybe do mark-to-market rents, or we can fill that vacancy, or we can create value, or whatever it needs to be done on these industrial assets, even if that's renegotiating a lease, what we can do to create that value for our investors. So specifically today, we want to talk about F Street Yuma LLC. We're extremely excited about this opportunity. It's a great opportunity. We've actually been working it since the end of 2024 is when we started working this deal, started working with the seller on the asset. And we're finally in a position where we'll talk about those uniqueness today, about why we're here today and why we love this opportunity. But I'll let Lane dive into the asset itself.
Yeah, so as many of you know that have been following us for a while, there are several boxes that we like to check on our industrial acquisitions. So F Street Yuma LLC covers quite a few of these. We like to target assets built before 2000, mainly because that allows us to go in at a lower cost basis. This asset was built in 1989, but it's still got an awesome structure, great bones, large footprint, 286,000 square feet, with 18 plus foot clear heights throughout the building. It's also located in a great industrial submarket with low vacancy. This is a great logistics hub in Yuma, Arizona. Quick growing, access to a lot of great locations, which we'll touch on later. We also like, when possible, to get our investors cash flow immediately. Doesn't always happen, especially if we're buying some vacant buildings, which we've done in the past. But we were actually able to negotiate a lease while we were under contract for this entity. So we have a short-term lease in place with a tenant that's going to be storing some solar panels at the building. It's a 12-month lease, but they're taking the whole building and they're paying $140,000 a month. Now, with that $140,000 a month, we'll be able to pay investors a preferred return of 7% for the first whole year and reserve a lot of cash on top of that, roughly $570,000 on top of what we'll be distributing. Now, with that, we'll be able to plan for future vacancies and also likely still pay a preferred return to investors while the building is potentially vacant in the future. On top of that, we look for several criteria in future tenants. So we're looking for logistics companies, warehousing companies. We're trying to find something that is a market rate lease in Arizona and Yuma, but we've built in such a conservative pro forma that below market lease will get the job done for our investors still.
Yeah, absolutely. And that's why we love this opportunity, is we're getting this opportunity for well below replacement cost at a very low basis in a high rent market. So going specifically in like why we love this deal. So specifically Yuma, Arizona. And many of you may not know where Yuma is. Maybe you'll know 310 to Yuma, the movie. Yuma is a large MSA on the California, Arizona, and Mexico border. So it's actually located in, this asset specifically is located in the state of Arizona. One of the reasons we really love it is the really recent push to onshoring into the United States, being on the Mexican border and on the California border. As a lot of us have seen, a lot of businesses are either moving out of California or away from it and moving into really favorable states like Arizona, which is why we've seen Yuma be one of the largest increases in logistics hubs in the United States, being really close to, so Mexicali, Calexico, which is only an hour away, is one of the largest industrial boarding crosses in the United States outside of San Diego or El Paso Juarez. So That's one of the beauties is you're seeing that really close hour move. You're only 2 hours and 40 minutes from San Diego, less than 3 hours from Phoenix, 3 hours from Tucson, and then even you're a single truck drive from Los Angeles and Las Vegas. So that's one of the reasons we really like the Yuma market is it's great for A, logistics, and B, manufacturers. So going back to why we love this asset specifically, the price reduction. So we actually originally negotiated this project, as we talked about, we've been working it for almost 8, 9 months with the current seller, which is a large company under the Berkshire Hathaway, negotiating with them on how we can find tenants for the property. And we have recently negotiated with them to say, look, we're going to buy this asset in 45 days because we have this 1 year tenant, but we want a price reduction, and we got a price reduction down to 8 million. So that allows us to say, look, we now have a really good basis in the property. We have 12 months of income after acquiring the property from the short-term user, giving us that really long runway to find the users. Because what the current tenant's paying on a gross lease is $5.87 a square foot, $140,000 a month on essentially a modified gross lease. Market rents in this market are $7, $8 plus. If you go to San Diego, California, you're at $18 to $19 for a new asset. If you go to Phoenix, you're at $14 to $15. We're literally 50% below those. And we can even get lower. We looked at it as we could be at $4.50 and still get our investors all their money back in cash flow going forward.
Yep.
So we see this as a huge upside opportunity, but with risk mitigation. And I'll let Lane go into the risk mitigation specifically, but why we're able to mitigate that risk with the cash flow and the low basis.
Yeah, 100%. So there's three big things that this deal provides to investors that mitigates risk, right? One, Nick already mentioned, it's the price reduction from $11 million to $8 million, which allows us to buy this building at a fantastic basis. I know it's only a 12-month lease up front, but that's still a 16% plus cap rate that we're going into this deal with, which is fantastic, kind of unheard of. Aside from this, we're able to provide that upfront cash flow. So you're not left hanging with $0 coming into your bank account for the first 12 to 24 months. That's not going to happen with this. Aside from that, like I mentioned earlier, we'll be able to reserve some of those funds from this first lease to be able to help with operating expenses, interest costs, potential capital expenditures, tenant improvements for a future tenant, right? These industrial buildings aren't cheap to be able to maintain even when they're vacant. So we like to make sure to have that spread built into our models to make sure that we're covering the cost and we don't have to go back to investors and ask for money. That's the last thing we want to do. We're not going to do that, right? Aside from this, we're reserving over $1.2 million upfront in our sources and uses, which you'll see on the next slide, to be able to cover these operating costs, interest expenses as well. Not just the cash that we're getting from the initial lease, but also built-in dollars upfront that's going to help us float the building in any future potential vacancy. You probably saw this deal has a really high IRR, and that's not because we're using super aggressive assumptions. We're still being conservative, making sure that we have the reserves built in that's necessary, and we still think this deal will crush it at the end of the day.
Right, and absolutely. And it's all about who's that end user here too. And while we've been marketing this property for the last few months and working with our broker down in the market, we've already gotten a lot of traction. We're already seeing it from users. One of the beauties of this building, talking about onshoring, is power. The building currently has 4 megawatts of power, but is expandable up to 20 megawatts, which really plays to potential data center users and plays to potential manufacturers who are looking to be in the market, a market of Yuma that has a really strong labor force, and again, is on the Arizona and US side of the border. So that's again why we really love it. Going to the sources and uses, as mentioned, purchase price is $8 million. We're going to be reserving approximately $1.25 million in capital reserves and interest reserves to assure, as Lane mentioned earlier, we're going to be very conservative. We have 12 months of rent. We're also going to be paying out our preferred return during that time period. And then even after that, we have an additional 15 months. So we'll have over 27 months to find that next tenant, find that next user, whether it's a user sale or a tenant. And then we'll also be having debt here of approximately $6.3 million on the asset as well. That's again covered in that runway we've talked about.
Yep. Investment structure here, if you've been with us for a while, you know exactly what it is, right? It's a preferred return. So with this deal, you're getting a 7% preferred return. And until that's paid back, we don't start paying down your capital. But once we paid your preferred return, you're all caught up. Then we can start paying down your initial investment. And then once you're fully recapitalized, meaning your full investment's returned, your full preferred return, your interest is returned back to you, then at that point is the only time we start to split, right? And usually we see that on a large refinance, on a sale, but F Street doesn't see a dollar until you've made all your money plus interest back.
Yeah, what we call the money trees.
Money
And
tree.
the goal is here is whether or not if it's a sale to a user, that's different. But if we end up refinancing cash flowing, that just means you have all your money back, all your preferred return, and you're continuing to get that check on a monthly or quarterly basis.
Yep.
So talking about kind of the different ways we're looking at this opportunity, as we've talked about, we'll look at a few scenarios. We're of course going to analyze the market as we have this 12-month lease. They also could potentially extend. And we look at whether we're selling to a user or we're bringing in new tenants. We're really open to both opportunities. We'll kind of show the difference here on how these different IRRs hit and how these different opportunities hit. So first one specifically, we're going on a price per square foot. Just being conservative in the market, what we're seeing in the event we sell to a user and call it, what is it? What are you using, month 24?
Month 24. Yep.
So having a 24-month period to find a user. So really showing the sensitivity analysis of what it looks like at $50 a square foot, which is what we're using conservatively. And again, this is to reiterate how low of a basis we're getting this building. We're paying in the 20s, and a new building is going to cost 80 plus to build on a building of this size. Probably more approaching $100, $120 a square foot. $50,000 to $60,000 building is going to cost 120 plus. So there's just to show you the difference in how competitive we can be to attract different users to keep the basis low. So that's really showing, again, we're being conservative at a $50 per square foot sale, and that would really mean in a 24-month period, $100,000 turns into 176. So that's just to kind of show this scenario, and then Lane wanted to go in tenant scenario.
So that was the sales scenario. And in this scenario, a longer term hold means that we're eventually finding a tenant. So really quick, I just want to say in both of these scenarios, we're expecting a 12-month vacancy from the end of the first lease to the beginning of either the next lease or to a sale, right? And that's where the reserves are kicking in. But in this scenario, we are purchasing the building, same as the first. We have the lease in place for the first year. We're assuming 12 full months of full building vacancy before anything happens. And then after that, we're assuming 140,000 square feet, so about half the building, be leased up to a tenant. And we're assuming under market rate rents at about $6.50 a square foot. So we're trying to be conservative there. All of these estimates that we use in our model are a bit arbitrary. We do our research, but we don't know exactly 12 months after the first lease that a tenant will sign. It might be 2 months and it might be 14. So we like to err on the conservative side always. But after that, we're assuming 12 months past that. So in month 36, roughly, we're going to find another tenant to take the rest of the building at $6.50 a square foot. Now, $6.50 a square foot is under market today.
Well under market, yeah.
And if you're not accounting for inflation either, that's hopefully going to be even further under market in the future. So hopefully we exceed those expectations if we do go to lease in the future. But you can see what the cash flows are here. Mind if I borrow the pen for you for a second? So we mentioned in the first year, we have those cash flows from the tenant that's in place to pay your preferred return. In the second year, we're not assuming a tenant's in place, but we're still assuming that we can use those reserves that we set aside in the first 12 months to still pay you a preferred return. After that, we're assuming the building's fully vacated towards the end of year 3. We're able to do a large refinance. So what we talked about earlier, you get your preferred return for the whole year, which is still $7,000 if you're a $100,000 investor. Then we're paying back all of your capital. All of the $100,000 that you invested in this deal gets paid back to you on top of $21,000 that you earned in interest over the last 3 years, likely beating the stock market. Who's to say? Then you get your Class A split between F Street and you, and that's $57,000 additional dollars for a total of $165,000, and you're still in the deal. We haven't sold at this point. This is just a refinance based on conservative estimations. I believe it's a 70% refinance at 8 cap loan to value. So this is a very feasible situation in which we can do this. Past that, we're splitting 50-50 between F Street and the investors for a year, which is still over 7% rate of return on your investment, which is outstanding for a 50-50 split.
After receiving all your money back.
After receiving all your money back. That's right. At the end of the day, we're predicting a sale at a 9% cap rate in year 5. A cap rate, by the way, is just the net operating income of the property divided by the building value. So I know we've been throwing that term around quite a bit today, but that's how we look at cap rates. We think 9% is a good estimate in this market for a building of this size and of this age, which delivers another $72,000 to investors. So at the end of the day, we predict that if you invest $100,000 and we go this long-term hold route, we could distribute to you over $250,000 in the course of 5 years. I'll give
Yeah.
you the pen back here.
No, that's fine. So that's really the scenario. And again, well, happy to go through questions. I mean, here we have a little bit of sensitivity analysis on different rates, how it affects the IRR. If we really go to achieve what we're actually seeing in the market at an $8 per square foot rent, that's going to push us obviously to a much higher IRR. This is again us being conservative. As we mentioned earlier, we could even push the sensitivity to a very low end at $4.25 a square foot, which would still return 100% of your money and cash flow back. So that's again why we like the market, and we talked about it's all about the asset as well. In the market, we like the Yuma market. We love the location. We love the building and the quality it's been over the time period with the clear heights, with the power to it. There's also IOS space, which is industrial outdoor storage. So we have excess of land that we can also lease out. So we see a lot of value in this asset in the long term. So again, if anybody has questions as we go through it, but the other benefits we'd like, so there are questions.
Yeah. So the question was, what happens if we find a tenant much faster than we expect, and what happens if we find a tenant slower than we expect, right? So we have reserves built in to last at least 16 months prior to having to go into the well and fund this project from an outside source, right? So we don't feel strongly that that is likely. If we did, we would reserve more cash up front, but we think we're already being pretty conservative on that. Plus, as Nick mentioned, our break even for a 20% IRR is leasing up the building at $4.75 a square foot, which is about 50% of market. So if we get desperate at the end of the day, we can probably take that route to find a full building user, maybe on a short-term lease to give us some more runway to lease to maybe better suited tenant. But we think there's a lot of routes that we can take to completely avoid that situation. Nothing's impossible, but we really like how we've mitigated the risk on this project. And then simply put, if we find a tenant faster than that, the IRR goes up on this deal significantly because the sooner you can get cash flows into the building, the better your IRR is, the better your returns to all the investors are. So
right, because IRR is a time value. So and if you look, or if we find a user, for instance, earlier, because something that's not shown in our sources and uses here, and something that's not shown in either of these scenarios is we do have additional TI allowances. We do have additional broker's fees built into these refinances.
Yep.
So like the refinance here or into the sale here. So we have these built into those numbers. So for those users coming in, we have built in specific TI allowances, broker commissions, all of that would be needed in the event of a transaction. So those are all baked in as well. And to Lane's point, if it comes sooner, if we're talking about here versus here, that's 12 months of additional money that's being returned to our investors.
Exactly. Yeah. That $1.2 million that we're reserving up front, if we don't have to dig into that cash, it doesn't just go away. It gets returned to investors if we find a lease quickly. So
exactly.
The faster, the better.
Question was, why are we getting it so cheap, and why couldn't we not get a longer term tenant to start? Great questions. So that's part of it. So why are we getting it so cheap? I mean, it's as mentioned earlier, it's a large national player. I mean, we're talking a $100+ billion company that's not in the real estate business. We are in the real estate business, and for us, it's look, we'll take over this asset for you. We'll take the risk. Because obviously there's risk associated with owning real estate and owning real estate that will likely be vacant in 12 months. But we're in that business where we know how to improve properties. We know how to manage properties. We know how to work properties. So that's really the difference. When it comes to a long-term user, that's a great question. We'd love to have a long-term user here. We've been working with potential long-term users. We haven't finalized those, which is why we're open to a short-term lease that provides immediate cash flow at a really good basis. To Lane's point earlier, almost an 18 cap rate going in.
Yep.
So,
but there have been 4 to 5 interested parties that are knocking on the door. It's not easy to get those deals done, and they take time.
They take time.
So if we can get this upfront cash flow for our investors, we thought we may as well take it. It gives us longer runway. Plus, we know that these guys are likely leaving the building after 14 months.
Yeah.
So we can still market the building for the future when one of those longer term users can come
Yeah.
into the
And it's a
building.
win-win. It's a win for us that we can now buy the building at a lower basis, and it's a win for the seller that they can essentially sell the building and de-risk it from their side, take their cash flow and move on. So good questions. Yeah. So the questions are there any planned capital expenditures or CapEx for the building? And what is the condition of the building? Good question. So building itself, we've done a PCA, a property condition assessment. We acknowledge we have those in the sources and uses. There's a few $100,000 of capital improvements that we've baked into our sources and uses. Really just general things. There's no major CapEx items. Roof's in good shape. It's an original metal roof. So it's in great shape. Those roofs last 60 plus years as long as they're maintained well, which again, having a great user here has maintained the roof really well.
Parking lot needs a little bit of work, right?
Parking lot needs some work, but again, that comes into us whether or not we're going to bring in an iOS potential player or what user might want this if they need to extend on the building. So there is minor items, but we've got all of those accounted for in reserves and built into that first year cash flow. Because as mentioned, we're going to have almost $2 million of revenue coming into this property over the next 12 months. And that covers not only our debt service, but our costs every month that go into maintaining the building, maintaining the roof, maintaining the parking lot, and all those costs associated.
Yep.
The question is, when we're referring to low vacancy, is that regional, local, or what's the question? So really, when it comes to vacancy, there are no other vacant buildings over 100,000 square feet in Yuma or the Yuma market. I mean, the Phoenix market and the San Diego market, you can argue vacancy rates there, whether that's Class A brand new assets or it's Class B assets. In the Yuma market, this is the only building over 100,000 square feet. So we really have the opportunity to play to these manufacturing users and we really have the only opportunity, the only building, unless you want to build new and pay 2-3 times what we're paying for our building. Okay. Yeah, so we've got a lot more questions. So we're just going to go to the key dates here, and then we'll circle back to a lot more questions. Specifically, key dates. As mentioned, we do have a little bit of quick closing. Our agreement with the sellers, we're going to close in 45 days from a week ago. So opened it yesterday for equity investment or today. Funds are going to be due by September 12th, and we're going to be acquiring the asset. Wrong names listed there. We're going to close on September 19th. And then again, we always have more opportunities coming. As mentioned, we've had 2 opportunities here in the last 7 days, both of which we've loved opportunities. Opportunities have been working for almost the entire year, and we'll continue to have more as we come up here in the near future. Something we'll bring up as always, this is a project that we'll be closing here at the end of October, early November, is Access Apartments in West Allis, Wisconsin. Specifically, 147 unit market rate development. We've talked about it before. Why we love this opportunity is extreme low vacancy market, great support from the municipality. On the raise itself, we've already raised a significant portion of the equity, and we're going to continue to finalize that raise over the next 60 days here before we close. Main benefit here is the TIF.
Yep.
I mean, we have huge tax bonus financing from the municipality, from the city of West Allis, great support and a great community, and a great product. We're really the only ones delivering this garden style units in the entire city of West Allis. So we love the opportunity, great cash flow, great IRRs, and again, it's a multifamily asset. So when we say you want to look for diversity and beating the market, it's, hey, invest a little bit of multifamily, invest a little bit in industrial, lots of great opportunities to invest in.
Yeah.
So we'll now go through questions. Apparently we have a lot of them, so let's run through them. Great question. So question was depreciation benefits associated with the asset. We actually have a slide on this.
We skipped over it quickly.
Going a little specifically on depreciation. So when we're acquiring this asset, so we are going to be depreciating immediately. So we'll likely do, upon the acquisition, a cost segregation study. So we'll be depreciating the book value of the asset upon the acquisition. So those of you, it would be for an offset of passive income. If you're active in real estate, it'll be active offset to your income. We're happy to go over it more specifically for you as an individual because everyone's different as it comes to what passive income you might have and how you can take advantage of those appreciation benefits. But yes, because we're buying this asset and we're buying it immediately as a form of manufacturing building, there will be significant depreciation benefits here.
Yep.
Good question.
There are not in terms
So
of
the question
no,
was,
sorry.
is there an opportunity to extend this current lease or opportunities for this tenant to stay there? Not necessarily. I mean, we look at the current tenant is, as mentioned earlier, a solar panel storage.
Yeah.
So when we signed the first lease with them on August 4th, they moved to the next day. It's truly they put storage, solar panels, store them in there, put them in, turn off the lights, and they exit. It's for a project that they're developing in the area. Obviously, the southwestern United States has a significant amount of solar panels. So they have a lot more sunlight than we do here in Wisconsin. So that's really for them, it's storage. So it's when their job starts, which they're anticipating is 14 months from when they originally signed, which would be just over 12 months from when we acquire the asset. There is a chance if there's delays or they need to extend it out that they would do that. Or if they have another job.
Yep.
That the 3PL that's working with them on this could potentially extend to a longer term. But from our understanding, the current tenant, they won't do longer term leases. But again, if they wanted to, they love the asset, we will absolutely work with them. That's a great question. I got that one?
You got it.
All right.
All you. You're on a roll.
The question is the building climate controlled and what types of tenants will fit well in this building? So good question. Building is not climate controlled. It does have AC units in it, but it's not fully climate controlled. It's climate controlled, but it's not cooled. So single temp building. The types of users, we'll be targeting here are users, true users that will be manufacturers, logistics companies, potentially data centers with the expanded power. For tenants, for us, it's everything all over the market. So, some of the major players in the market that are expanding are Kimberly-Clark has a large new facility that's going in for manufacturing and logistics. Amazon just built out another large facility, and a few other major users, Fortune 500 plus, have entered the market recently.
Yeah, the question was, can this building be subdivided so that we're not relying on one single tenant? And the answer is yes. I mean, sometimes there's TI dollars, tenant improvement dollars that have to go into buildings to make this happen, which is likely the case for this. But the building has a great footprint, so we could essentially divide it, whether that be in half or if we find 3 tenants that want to take the building, we can make this happen. There's nothing necessarily from stopping us to do this. There's some office in this building as there is with a lot of industrial. So potentially if we found a larger industrial user and a smaller office user, that's often a pair that can happen in these types of assets.
That's a great question. The building demises very well. And I don't have a perfect picture up here, but it demises very well there's an approximately 140,000 square foot space. So we have these dock doors right here and these dock doors here. So it demises very well. I believe it's right around here. Happy to share that more. I believe it's in our investment packet as well. There's very specific space here that demises into, like I said, it's about a 50-50 split. I think it's slightly more. It's about 140 some thousand on one side, and then a little bit less on the other side. So yeah, great question. It demises very well into 2 spaces. And the Yuma market we've talked about really has a lot of users in the 50,000 square foot range. So that's been a lot of users. But again, it's because there's no major buildings like this that are over 100,000 square feet, and we have 286,000. So for us, it demises well, so we could attract one of those 50,000 square foot users who, rather than paying $12 to $14 a square foot in a single-use building, could take 100,000 square feet at $5 to $6 a square foot and have more space and ability to expand and still be at a lower rate. So great question.
Yeah. We were asked to expand on the debt. Is it fixed rate? What are the terms? We're still locking up terms with our lender, and we're talking to several lenders to make sure we're getting the best terms possible. We'll likely be looking at something which is SOFR, so that's a secured overnight financing rate. It's kind of a benchmark that a lot of financing institutions use to come up with these interest rates, right? So SOFR plus a margin, call it 2.5% to 3%. I'm not sure what SOFR is today. I haven't checked, but
4.3-ish.
4.3. And then we're looking to get an interest-only period of roughly 36 months on this. This is super important for potential vacancy in the future so that our interest payments aren't significant compared to what it would be if the loan was amortizing over a number of years. We do expect the loan to start amortizing once we find a tenant, if we go the long-term hold scenario. And then, of course, there's normal origination fees up front, 50 bips to 1%, and then there'll be a small fee on the exit of the loan as well. Yeah, just more questions on vacancy rolling in the market. We can definitely expand on that. If you'd like to reach out to me specifically so we can talk after this meeting, shoot me an email, Lane, Lane, @fstreet.com. We're happy to pull any reports that might help you with this information.
Question was, what was the previous tenants and why did they choose to leave? So this was actually a built-to-suit building. It was a yarn spooling facility for Shaw. So Shaw Flooring, one of the largest flooring manufacturers in the United States. Again, a Berkshire Hathaway company. They just exited facilities. They've consolidated their manufacturing. They're now based out of Georgia and have manufacturing facilities throughout the United States. They've just exited the building. They've maintained it very well. For them, it was just dating and consolidation. So it's been a single user since it was originally built in 1989. And then they recently exited only a few years ago.
Yep. All right, that's all the questions we had. Again, if you have additional questions, please shoot me an email, Lane, Lane, @fstreet.com, or the same for Brian, my counterpart here, Brian, @fstreet.com. You saw how quick normal closed up. You see the IRR on this. It's a 30+%. This is going to close quickly. So if you're interested, please reach out, start on your portal today, fstreet.com/invest. We know that the funding close date is September 12th. It's going to close a lot quicker than that. So please reach out, start your investment today, ask any questions that you have. We'd love to get you involved in this deal. Yeah, thank you very much for your time. We really appreciate you tuning in with us today. And Nick, if you have any other closing remarks.
No, thank you again. As I said, if you have any other questions, again, please feel free to reach out or visit us at fstreet.com. Thank you.
Thank you.